Coinbase stock today looks a whole lot different than Coinbase stock did several years ago when they had their IPO. Now, if you're somebody that's holding coin stock or thinking about investing because you think there's value to be had here, then you might want to start out with these two pieces that we wrote last year, which really talk about what the company does and some concerns that we had with Coinbase's business model. Now, I'll put links to these in the description of this video, but if you're unfamiliar with Coinbase, this screenshot taken from their homepage should make it quite clear what they do. So they say, we're the most trusted place for people and businesses to buy, sell, and manage crypto. That's probably right based on what we've looked at in this sector. Now, several years ago, Coinbase had their IPO, and you can see here it closed at $328 per share, and at one point, their market cap had exceeded $100 billion, so it's about $15 billion today. And you can see that Coinbase, they say, has soared in value in the past year alongside Bitcoin and Ethereum, which account for most of the volume on the site. That's quite important. So fast forward today, here's how things are going. So Coinbase, just over a month ago, sued the SEC after months of silence from federal regulator. And that's not in a good place to be. When you go to their homepage and you read this long blog entry by their legal team that's titled, "We asked the SEC for reasonable crypto rules for Americans. We got legal threats instead." This is not a good position to be in, regardless of whether they're right or wrong. And it's almost makes you think about Illumina getting in a tangle with regulators. And these aren't the people that you want to piss off. Now, what happened is that the SEC gave Coinbase what's called a Wells notice regarding aspects of their platform, including the company's spot market, staking service, Coinbase Earn, Coinbase Prime, and Coinbase Wallet. There's the potential civil action that may result from this, which could result in penalties, all kinds of unknowns. And the short story here, as described by Coinbase, and if this is true, then you can certainly understand their frustrations. Last summer, they started talking with the SEC about how to sort out some concerns around cryptocurrencies. If you've been watching the news, and most people in the United States take a pretty vested interest in politics and would probably have seen this come up. It seems to be getting political, as everything does in the United States. But they started talking with the SEC about a potential resolution that would include registering some portion of Coinbase's business with the SEC. The SEC asked them to do that. They said, sure, absolutely. So then, because there isn't a precedent for this, they asked Coinbase for their views on what a registration path for Coinbase could look like, because there's no existing way for a crypto exchange to register. Well, then Coinbase went and proposed two different registration models. They spent millions of dollars on legal support to build these proposals and repeatedly asked for the SEC's feedback, and they say they received none. They met with the SEC more than 30 times over 9 months. That's a lot of meetings. So if you're unable to establish rapport on the other side when you meet that much with another party and things go sour, it just goes to show that a lot more meetings wouldn't have done any good, and that there's some potential problems here with this relationship. And then it says here the SEC staff agreed to provide feedback earlier this year, and that the day before that scheduled meeting for feedback, the SEC canceled on Coinbase and told them they'd be shifting back to an enforcement investigation, and that's when the Wells notice was issued. And there's some very telling language when you look at Twitter and the response from Brian Armstrong, who we respect a lot as CEO of Coinbase. He's somebody that doesn't allow politics in the workplace. Bravo to this man. And he says here, today, Coinbase received a Wells notice from the SEC focused on staking and asset listings. He says this is important. A Wells notice typically precedes an enforcement action. So there's a lot of uncertainty there for investors. And this other tweet, he says here, the SEC simply has not been fair, reasonable, or even demonstrated a seriousness of purpose when it comes to its engagement on digital assets. So that's a pretty big accusation there, and I guess that's backed up by the facts that we discussed. If in fact those items are true, the story that Coinbase tells is true. And here's their legal lead saying, but if courts are required, so be it. We'll defend the rule of law. Well, yeah, that's just not a good place to be, because you end up spending a lot of money and resources battling an entity that ultimately decides your fate. So if we take a step back and we think about this, we can go read the rules that determine securities and debate what cryptocurrency is. But the problem is, in fact, that crypto assets are not securities. There's nothing to invest there. These are only speculative mechanisms with no intrinsic value supported by greater fool theory. And there's somewhere around 10,000 different cryptocurrencies listed on Coinbase. You need to ask yourself a bigger question, which is, why do you want to invest in Coinbase? The Coinbase thesis. Well, Coinbase powers the crypto economy, so they say. These are the first two lines taken from their 10K, they say. And whenever somebody says this, you really it's a red flag for us. Our mission is to create an open financial system for the world, okay? They're a pick and shovel play on cryptocurrencies and Web 3.0, which has been nothing but a disappointment so far. That includes blockchain and ICOs and DAOs and all the JPEGs that command hundreds of thousands of dollars. Not surprisingly, all that stuff has just fallen flat on its face. Now, this is a case of investing in the gold miner versus the gold. An analogy would be all the pieces we did on crypto miners, so Bitcoin miners. We always said, don't invest in the miners, invest in the gold. Because when you invest in the miner, you're expecting leverage on the asset with minimal risk, which gives you alpha over just purchasing a diversified basket of cryptocurrencies or the gold in the case of Bitcoin. Well, when we look at Coinbase, one of the problems we had was the exposure you get to irrational retail, and I hesitate to call them investors, speculators, versus institutional investors, or perhaps also speculators, though they go about it with a methodology and the capability of generating alpha because they're experts at that sort of stuff. When we look at Coinbase's financials, we see heavy retail dependence here. Last year that would be 2 years ago in 2021, we noted that 88% of their revenues came from retail transactions, and that once the hype dies down surrounding cryptocurrencies, that could very easily go away. Well, fast forward to 2022, we see 70% of 2022 revenues coming from retail, so it's dropping. But it jumps to 80% if we remove interest income. So look at the items that we've highlighted for 2022 in this table. So you see at the top there, that's consumer transaction revenue. You can divide that by total transaction revenue. You see institutions play a very small part in transaction revenue. Then below that, you see blockchain rewards. So it's good to see that this is one of the line items increasing. That could have something to do with Ethereum's switch over to staking. You don't need to know anything about that except to know that it generates rewards. And this interest income item, look at how sharply that's increased from 2021. Naturally, we want to know what's going on there. So when you look at the definition for that, it says that this bucket earns income on fiat funds, so real currency, under a revenue sharing agreement with issuer of USDC. Okay, what's USDC? It's what they call a stable coin, and essentially it's a crypto token that represents $1. It's supposed to be backed by $1. You might ask, well, why don't you just get $1? Well, that's a great point. That's exactly what we would do. But they actually use this for transacting in the crypto world, along with a nothing short of extremely scary cryptocurrency called Tether, and we've written about why we have so many concerns around Tether. It's incredible that's allowed to exist, and the U.S. government actually had flagged that. Now, it also says here this bucket could represent interest income on loans issued to consumers, hopefully there's not a lot of those, and institutional users, along with customer custodial funds, which largely represent cryptocurrency. So what's happening here is that the issuer, it's a firm called Circle, and we've written about them before. I'll put a link to that piece in the description of this video. But they hold this $30 billion fund that's managed by BlackRock. That's great. So there's some transparency there. And you can see here that they're acting very quickly to protect their reserves from U.S. government default. That's great. At least in the case of USDC, we know what reserves they're holding, unlike Tether, which won't let anybody know aside from some flimsy attestations of what they're holding. Nobody actually knows how much exposure they have to Chinese commercial paper, but In this case, we see Circle holding the USDC stablecoin fund, a $30 billion fund, and generating interest off of that. There's potentially a lot of money to be made when you start generating interest off a big fund like that, and a temptation to extend yourself a bit, which is what Tether may have done, hunting around for commercial paper. But we see USDC, Circle, the firm holding that fund, acting much more conservatively. But the question here is, what's that revenue split look like? So interest rates have certainly gone up, and both Circle and Coinbase stand to benefit from that, thus the spike we see in that category. Now let's talk for a second about the performance of Coinbase over time. Since their IPO, their market cap fell from $80 billion to $15, so they lost about 80% of their value. Contrast that to the green line here, which is Bitcoin, so that's quite interesting. Would be nice to be able to take this data and run a quick correlation on it to see just how correlated these two assets are. You could see them moving together quite well. The pink line across the top, that's the return of the QQQ or NASDAQ. Now, when we think about investing in Coinbase, an alternative, as we said earlier, is to buy a basket of cryptocurrencies. Well, what do you include in that basket? We've looked at this question before. And do you include the dog coin, a fictional coin made up out of nothing that was started as a joke? Is that something you actually want to seriously consider adding to your basket? We wouldn't. What about stable coins? These are US dollars. Just add US dollars if you want that exposure. The only thing that you're going to get exposure to there is potential downside if Tether implodes. So no, you wouldn't include stable coins. So now you see a problem that if you're going to put together a basket and you try to weight that by market cap, you need to put some due diligence into that. So what we did, rather than mess around with all that rubbish, is we simply followed ARK's thesis on Bitcoin, the largest. It's more than twice as large as the runner-up Ethereum, much larger than the rest of these cryptocurrencies. We put about a 1% bet into Bitcoin a while ago, I think around the $10,000 mark, mainly to serve to diversify our overall portfolio of assets. Now, we've written about that decision. Here you can see a number of articles we've written about Bitcoin on the left. These are all good reads. These two on the right, particularly interesting. So the first is why a Bitcoin crash may be imminent in December of 2021. The follow-up piece, Bitcoin is crashing and burning. What next in July of 2022? Those are both good reads. I'll put links to those in the description of this video. And long story short, the exposure that we're getting to cryptocurrencies failure so far is Bitcoin, and we're going to stick with that for its diversification effect. So just getting back to Coinbase, there's too much regulatory risk around this asset right now. They're trying to move forward in a politically fractured nation where logic and common sense are long gone in favor of political pissing contests. It doesn't matter about how good or bad cryptocurrency is. People just use that as a political pawn, and rarely do the people who matter get to be considered in these decisions. So it's easy to hear Coinbase's frustrations, but we've no time for this drama, so we'll let them get on with it. If you're looking for basic crypto exposure, you can do what we said, two options here. Buy a basket of cryptocurrencies if you're willing to sift through what's out there, or you can just buy Bitcoin, which is what we did. And Coinbase seems like a solid platform to do both. So we'd be interested in taking another look at Coinbase once they've been able to sufficiently diversify their revenues away from retail investor transaction fees. Now, if you like this video, please click this Nanalyze logo here, subscribe to our channel, support us, and then I put up another video here that you might like. Thanks for taking the time to watch this today.